Guys, by popular demand, we're doing another reaction video. We're focusing more on the people that we kind of agree with, like Warren Buffett.
Yes.
We did Peter Lynch, very popular. People loved it, said, give us more. So this is a Warren Buffett question that was asked of him by Becky Quick. So let's just watch it together, Josephine.
Robert Thomas from Toronto, Canada, and he says, Warren, why are you recommending listeners to buy now, yet you're not comfortable buying now, as evidenced by your huge cash position?
Well,
So this is a question we get all the time.
Right,
Mo.
and this was back in May or June, so markets were even higher at this point.
So this is incredible because we get this question all the time. Paul, if you think stocks are so overvalued, I show everybody this. My stock market to GDP with the S&P, it shows as of this very second, 62% overvalued going back to 1929. So yeah, I get it. And I'm sure he's going to say something very similar to what I say. Not because we're the same person, but you know.
explain the position isn't that huge when I look at worst case possibilities. I would say that there are things that I think are quite improbable, and I hope they don't happen, but that doesn't mean they won't happen. I mean, for example, in our insurance business, we could have the world's or the country's #1 hurricane that it's ever had, but that doesn't preclude the fact we could have the biggest earthquake a month later. So we don't prepare ourselves for a single problem. We prepare ourselves for.
So ironically, what just happened last week, 2 weeks ago?
Big hurricane.
Big hurricane hit. They're talking about a lot of insurance companies going under. And he sits there and says, listen, is it possible? Sure. We have houses in Mexico and Turks and Caicos. 1 week, earthquake hit Mexico. Next week, Turks and Caicos hurricane hit the house. Okay. We happen to be fine. But the point is, these things do happen.
And it just shows if you buy stocks over a 5-year period, you have no idea what's going to come. There's going to be a lot of curveballs thrown your way.
And a lot of good things happen too.
Exactly.
For problems that sometimes create their own momentum. I mean, 2008 and 2009, you didn't see all the problems the first day when what really kicked it off was when the Freddie and Fannie, the GSEs, went into conservatorship in early September. And then when money market funds broke the buck, I mean, there are things that trip other things, and we take a very much a worst case scenario into mind that probably is a considerably worse case than most people do. So I don't look at it as huge, and I'm not recommending that people buy stocks today or tomorrow or next week or next month. I think it all depends on your circumstances, but you shouldn't buy stocks unless you expect, in my view, you expect to hold them for a very extended period, and you are prepared financially and psychologically to hold them the same way you would hold a farm and never look at a quote and never.
So I remember I took this from Warren Buffett. Talked about your home, and there's nobody on top of your home giving a display of how much it's worth every single day. Like I think back to 08. Yeah, I think back to 08. We bought a lot of real estate in 08. And after we bought the real estate prices still fell. But I didn't care because I wasn't being told every day, hey, you bought it here and now it's lower. Because I sat there and said, oh, great, I bought this piece of real estate, and I'm sure over the next 10 years, I'm going to make a lot of money. And that was it. The difference is you have a Mr. Market every day in the stock market telling you every single day, this stock is worth less, this stock is worth more. And some days you feel good and some days you feel bad. But the big key here, he said, was if you're prepared financially and
Psychologically.
Very
important.
That's the most important part. Because it takes the good emotional and mindset standpoint of saying, what did I buy? This is why I keep repeating to myself. And I've said this on the show, and it's really become a mantra for me. First question, do I think this company will be around 10 years from now? If the answer is yes, my next question is, do I think revenue and profit will be higher 10 years from now than today? Or can I at least determine how much money it's going to make in the next 10 years? If the answer is yes to that, then can I pay a reasonable price for that future cash flow today? If the answer is yes, then I should buy it.
Then the psychology comes on top of it.
Yes.
You could be the best breakdown person of financials in the entire world. If it was just the financial side, you could be the best investor in the whole world.
Yep.
But if you can't stomach it and you can't understand and take the ups and downs, you're not the best.
Yeah, it doesn't take much to be a good investor in terms of knowledge. It takes more emotional IQ, I guess you'd say. All right, let's go on.
Never pay it. You don't need to pay attention to them. I mean, the main thing to do, and you're not going to pick the bottom, and nobody else can pick it for you or anything of the sort. You've got to be prepared to, when you buy a stock, to have it go down 50% or more and be comfortable with it as long as you're comfortable.
Did you hear what he said? 50% or more. You know, in The Big Short, they talk about how, in the book, they talk about how Michael Burry was known for buying a stock. And they said, Michael Burry's stocks, he'd buy them, they'd fall 50%, and then all of a sudden they'd do well. Even Warren Buffett sitting there, if you're not okay with them going up, mark my words, from January of this year until the bottom of this market, Warren Buffett stocks are going to be down and down a lot.
Now, there's a caveat to this. Buying good companies that go down 50%, not these fly-by-night companies that don't make any money and go down 90%. And you say, hey, it's okay. Warren Buffett's went down 90%. Well, Warren Buffett's companies have a ton of cash flow, and they can withstand it, and they're going to do better in the long run.
Yep, exactly.
You're comfortable with the holding. And I pointed out, I think a year, maybe 2 years ago in the annual report, just the one before this most recent one, I pointed out that there have been 3 times in Berkshire's history when the price of Berkshire stock went down 50%. 3 different times. Now, if you owed it on borrowed money, you could have been cleaned out. There wasn't anything wrong with Berkshire when those 3 times occurred. But if you're going to look at the price of the stock and think that you have to act because it's doing this or that, or somebody else tells you, well, how can you stay with that when something else is going up or anything? You've got to be in the right psychological position. And frankly, some people are not really careful. Some people are more subject to fear than others. It's like the virus. It strikes some people with much greater ferocity than others. And fear is something I really never felt financially, but I don't think Charlie's felt it either. But some people can handle it psychologically. If you can't handle it psychologically, then you really shouldn't own stocks because you're going to buy and sell them at the wrong time. And you should not count on somebody else telling you this. You should do something you understand yourself. If you don't
do something you understand yourself. I've always said, I have way more confidence in real estate than stocks, but I'm getting there in stocks. If I was buying a piece of real estate tomorrow and Warren Buffett looked at me and said, not a good buy, I'd say, didn't ask your opinion, Warren. I literally have that confidence in real estate.
Yeah.
I absolutely have that confidence in real estate.
And I do think if you don't understand it and you want to invest, that's where these low-cost ETFs can help you.
Absolutely.
You don't have to worry about, if you think to yourself, all you have to think is one thing, is the stock market going to be higher than it is today when I retire, no matter when that retirement age is? There's one answer to your question. Put your money in and let it go and never look at it.
And buy every single month along the way.
You don't have to understand the market to do that.
All you have to do is understand the U.S. economy and the relation of stock prices to the U.S. economy. If you understand this, look at this, guys. The average 10-year return going back to 1929, not including dividends, is 6.6%. When it's undervalued, the average return is 9.3. When it's overvalued, 2.3. So big differences, but here's the key. When it's overvalued 30% or more, the average return is a minus 0.1%. Again, none of these include dividend, but it makes sense. The more you pay for an investment, the less your future return. That's just a fact. But we never know the bottom. Like Warren said, you'll never pick the bottom. The question is, do you have the ability to sit there and be okay with your stock falling 50% or more? And I have had stocks fall 40, 50% as of right now, and it's only going to get worse. So I have to decide, what am I here to do? Now, the great news is I sell a lot of options, so I can do some tax loss harvesting along the way, which is a benefit that I have. But okay, but if you don't have that benefit, then you really got to be emotionally ready to buy stocks. Right. All right, let's finish it up.
You don't understand it yourself, you're going to be affected by the next person you talk to. And so you should.
I'm just going to end it on that. Here's the deal, guys. What he just said is key. If you don't understand it yourself, you're going to be affected by the next person who talks to you.
Because you think they understand it more.
Because you have no solution, so you have to sit there and grasp at everything. You know, I always joke with people and say, sometimes I'll look at somebody and say, I don't really believe what they say. Why? Well, because they just believe whatever the last person that said to them. That's the first time I've heard somebody say, it means they don't understand it. Right. If they just believe everything the next person tells them, they don't understand it. Right. I don't care what anybody, I've literally sat in a panel with a billionaire before, and I looked at him and said, you don't understand investing in real estate. I literally said that on a panel. By the way, he said he was a billionaire. I don't think he's a billionaire. I think he handles $1 billion or more and considers that he's not a billionaire. But I look at that saying, I have the confidence, look at him and say, you have no idea what you're talking about. And I literally said that. And then a bunch of lawyers came to me afterwards and said, I'd love to see your data. I emailed them all. Nobody responded. I emailed again. Guys, I'll show you my data. Nobody responded. And these are all guys who are big shot lawyers, blah, blah, blah. My whole point about that isn't to say I'm cocky. It's saying, listen, but you'll hear me say, I don't know about a lot of things. I don't know. And I don't care to know. Or what's an example? Oh, banks.
Yeah, we don't
I do care to know, but I don't know banks. So I don't buy banks. I have one bank. Yeah. I own one bank. It's because a guy I really trust in banking. I said to him, I really like this bank. Is it a good buy here? He goes, yes, it is. I think it's worth X. I was like, great. I'm going to go buy it then. And it was a guy I really trust his process. Yeah. So the whole point of this is, guys, we're going to do these reaction videos more about investors who are value investors because it's the repetition over and over of this process. And
it's funny. Warren Buffett sounds, like you said in the beginning, he sounds like every value investor has the same principles. The fine details differ, but the principles are exactly the same. You're going to hear the same thing from Munger. You're going to hear the same thing from Buffett, Joel Greenblatt, us, etc.
Everybody. So if you like these type of videos, we have a playlist right here. Go watch them. You're going to enjoy yourself very much. Thanks, guys. There are 3 things that you absolutely need in order to be a successful investor: the proper mindset, the proper emotion, and the proper process. Which ones are the most important?